All right, let's get right into it. Welcome to Ultimate Whiteboard Revision Session. Today, we are absolutely locking down that A-star in the 2026 syllabus for IGCSE Accounting 0452. We're zeroing in on limited companies' financial statements. Over the next 10 minutes or so of this explainer, we're going to run through a rapid concept recap, dive into some worked examples using official IGCSE command words, and even tackle an interactive pause and attempt practice question. This module, it's basically the fundamental bridge between everyday data entry and high-level financial intelligence. So grab your notes, put your phone on silent, and let's decode exactly what these examiners are looking for.
Here is our roadmap for today. 1. Core accounting concepts. 2. Mastering technical execution. 3. Interpreting financial ratios. And 4. Essential examiner insights.
Section 1. Core accounting concepts. Building the foundation. Okay, so listen up, because this is absolutely crucial. Cambridge has strictly updated its terminology for the 2026 syllabus to match modern international standards. When an exam question asks you to state an accounting term, you have to use irrecoverable debts and owner's equity with 100% accuracy. Old, outdated terms like bad debts, they literally will not earn you marks anymore. Examiners are laser-focused on this transition. Honestly, using the wrong terminology signals that you just haven't prepared, and it sets a really poor tone before the examiner even looks at your math. And this right here brilliantly illustrates the absolute golden rule, the accounting equation. You have to apply the business entity concept, meaning the business is entirely separate from its owners. Because of this, every single transaction has a dual effect. Think about it. If you buy a delivery van for cash, your van asset goes up, but your cash asset goes down. Throughout the entire financial year, your total assets must always equal your liabilities plus your equity. If this equation drops out of balance anywhere on your scratch pad, you instantly know, hey, a double entry error happened somewhere in my ledgers. You know, a massive trap students fall into is ignoring potential losses, which is a direct, textbook violation of the prudence principle. Let's say inventory in your warehouse gets ruined by a roof leak. You have to record that anticipated loss immediately. Never, ever overstate your profits or asset values. You also need to intimately understand the historical cost concept, meaning you record assets at their original purchase price, not what you magically hope they're worth today. Make sure you've mastered vocabulary like accrued, prepaid, realization, and consistency. External parties, like a bank manager deciding on a loan, rely on the absolute transparency of these concepts.
Moving right along to Section 2, Mastering Technical Execution, the Procedural Flow.
When you see the command word calculate, especially when it comes to something tricky like depreciation or inventory valuation, you must remember that examiners award method marks for visible logical flow. Seriously, this is the biggest lifesaver in the entire 0452 exam. If you make a tiny arithmetic error early on, but your procedural logic on the page is spot on, the examiner will still give you marks for the subsequent steps. But, and this is a big but, they can only give you marks if they can actually see your workings. Never do your correction of errors in your head or on some scrap paper you're going to throw away. Map it out clearly. Let's walk through a mini worked example of this execution journey. Imagine you buy goods on credit. Step 1. The source document is the purchase invoice. Step 2. You record this in the purchases journal, your book of prime entry. Step 3. It flows into the T accounts. You debit your purchases account and credit the supplier's account. Step 4. At the end of the period, those balances move to the trial balance to check your math. And finally, Step 5. It blossoms into your final financial statements. If you skip a step here or try to jump straight from an invoice to a final statement, that is exactly where those massive calculation errors multiply.
Now, when a question asks you to prepare a ledger account, the T account is still the gold standard, but you have to master distinguishing between your balance types. Under intense exam pressure, it is so easy to confuse balance BD, the balance brought down to start a new period, with balance CD, the balance carried down to close the current period. And mixing those up, it'll completely derail your trial balance. The balance carried down acts as the balancing figure to make both sides equal, right? Then it's brought down to the opposite side to kick off the next month. 100% mechanical accuracy is your goal here.
Oh, watch out for mathematical pitfalls here. Miscalculating the percentages between trade and cash discounts is such a common student trap. Let's say a business buys goods with a list price of $1,000, gets a 10% trade discount and a 5% cash discount for paying early. Well, trade discounts happen at the point of sale, and they don't even appear in the double entry records. You just record the purchase at $900. But cash discounts happen at the point of payment, and they absolutely do appear in the ledgers. Applying that cash discount percentage to the original $1,000 instead of the $900 is a classic mistake. Oh, and side note, when you're preparing manufacturing accounts, forgetting state symbols like raw materials or work in progress is a super easy way to bleed marks unnecessarily.
Section 3. Interpreting Financial Ratios. Achieving AO3 Mastery.
Okay, calculation is just the baseline. Interpretation is where the real accounting magic happens. This is our interactive pause and attempt section. Look at this scenario. A business's current ratio drops from 2.5 to 1 all the way down to 1.1 to 1. Now, obviously, this is a red flag for short-term liquidity, but just writing liquidity worsened is not going to earn you top marks. So pause this explainer right now, grab your pen, and write down 2 specific reasons why this liquidity drop might have happened. I'll wait. All right, let's see how you did.
If you answered with any of the following, you secured your evaluation marks. Number 1, maybe the business tied up its cash by overpurchasing inventory and now it's just sitting idle in a warehouse. Number 2, trade payables are being settled way too slowly. Sure, that temporarily keeps cash, but it drastically damages supplier relationships, which leads to tighter credit in the future. Or number 3, cash reserves were heavily depleted because of a massive capital expenditure, like they bought new factory machinery with straight cash instead of getting a long-term loan. You've got to provide these exact high-level insights to show the examiner you actually understand the mechanics behind the ratios.
And what happens when you're asked to compare 2 different businesses? Well, keep in mind that different accounting policies change the actual quality of the reported profit. For example, if Company A uses the straight-line method of depreciation, their asset values and profit margins are going to look wildly different in the early years compared to Company B, who uses the reducing balance method. Company B will report much lower profits initially just because of higher depreciation charges. You have to train yourself to look beyond those surface numbers. These internal policy differences make direct inter-firm comparisons super tricky.
So when a chunky 12-mark question asks you to evaluate a business's performance, please don't just stare at the numerical records. Financial statements only tell you the quantitative story. An A-star candidate is going to point out non-financial factors too. Things like poor staff morale leading to high turnover, a deteriorating retail location, or a newly damaged market reputation. These things can completely tank a company's return on capital employed in the coming years. They might be invisible in today's pristine ledger, but they completely dictate whether the business survives tomorrow.
Section 4. Essential Examiner Insights. Your Exam Strategy Guide.
Let's wrap up with some strict do's and don'ts straight from recent principal examiner reports. First up, poor handwriting. I know, it sounds basic, but examiners explicitly say that illegible handwriting in ledger accounts makes it utterly impossible to award those crucial method marks we talked about. Second, manage your time based on the question weightage. Please don't spend 20 minutes painstakingly formatting a 3-mark calculation. And finally, do not confuse revenue expenditures, like basic van repairs, with capital expenditures, like buying a brand new van. Mixing those up fundamentally breaks the accuracy of your statements and totally invalidates your final profit figures.
So take these strategies, apply them to your practice papers, and really ask yourself, are your logic and presentation truly examiner ready? Are you actually making your procedural flow visible? Are you sticking to that exact 2026 terminology? And when you interpret ratios, are you telling the real story behind the numbers or just stating the obvious? Go review your notes, try a full past paper applying these exact principles under timed conditions, and lock in that top grade. Keep questioning, keep evaluating, and I'll catch you in the next explainer.